choose a pension plan, getting a joint pension often appears to be the best choice, but is it? Here to break down the do's and don'ts of pension planning is Peter Cishecki with Everything Financial. Good morning, Peter. Good to see you. Okay, so first of all, what is a joint pension exactly?
A joint pension would be where the person receiving the pension, if they were to pass away, then an amount equal to what they were receiving or a percentage of, depending which one you choose, would then go to your spouse, partner, whoever is your beneficiary, so that you're ensuring that that income continues to them after you're gone.
Okay, so now when is a joint pension the way to go, and what are the other options even?
Well, there could be 20 different options of joint pensions, so there's different percentages. Okay. Am I taking more, leaving them less, or am I taking the same amount? And then there's really just one other option, which is a single life pension, which means you, the person who's retiring from the company, is getting a much larger amount of money, but you're leaving your significant other nothing.
Ah, okay. Now, what is the scenario if that partner or person, significant other, already has a pension? Is that
well, that's
transferable?
one of the scenarios, but here's the other thing, Carrie. Like, you're leaving this, in the joint pension, you're leaving this person money. You're taking less money too. That's going to be there for sure. Mm-hmm. The question is how much. What if that partner passed away? You've locked into a pension that is significantly less money for the rest of your life. And if they predecease you, you can't change it.
And that can't be altered in the contract?
Once you sign it, you're done.
Okay. Should you be getting a joint pension even if you're you do not have a partner?
No, single life pension for sure. But in 99.9% of the cases, as long as you're healthy, you can insure your pension, take that single life pension, but insure it. And then if you pass away, your partner gets the insurance instead of the pension, and the insurance is tax-free, where the pension is not tax-free.
Tax-free for which?
For the person receiving the income, because life insurance is tax-free. So the insured pension, it used to be called pension maximization. Take the single life, insure it, and if you pass away, your partner gets the life insurance instead of the pension. Same amount of monthly income can be derived from that. But what if that partner, like we said, passes away? You haven't signed into the lower pension. You can always cancel the life insurance and keep that extra money. And sometimes we're talking $500-600 a month or over $1,000 a month, depending how long you've been at your employer and how big the pension is.
So it sounds like there's a lot of different scenarios and a lot of different options here. How can you sort of pinpoint what's best for your personal situation?
That's where you really do need the registered financial planner. Go in, but you might want to go in a year or two even in advance of making that choice and start to look at all the different options and see which one's best for you. But there is that key thing. You have to be healthy enough to be able to get the insurance to insure your pension. If you've had some sort of medical things that make you uninsurable, then you've all of a sudden you've directed yourself to joint, I don't know which variety of joint option, but the joint pension is going to be the only way to go if you're uninsurable. So looking at it earlier rather than later gives you more choice.
So earlier is in a couple of years before you plan to retire and plan to get that pension.
For sure.
Good advice this morning. Peter Cishecki with Everything Financial. Good to see you.
Great to see you. Thank you.